While everyone was staring at the red candles and refreshing ETF flow data, something happened in the Southern Hemisphere that the mainstream crypto press barely mentioned. Ripple just secured a regulatory foothold in one of the most payment-dense markets in the Asia-Pacific region. And they didn't apply for a license. They bought one. Think about what that signals. When a company of Ripple's scale bypasses the line entirely and acquires a licensed entity to accelerate access, that is not the move of a company still trying to prove itself. That is the move of a company that already knows what is coming and is positioning before the flood. Today, we are going to decode exactly what Ripple's acquisition of BC Payments in Australia actually means for the XRP network. Why a $750 million share buyback right now is one of the most telling institutional signals of the quarter. What the MasterCard partnership actually unlocks, and why the math, not the hype, the math, points to something retail investors are dramatically underestimating. Let's get into it. Welcome back. This channel is not about price predictions or moonboy targets. We are here to read the structural signals, the acquisitions, the regulatory chess moves, the on-chain data, and translate what they actually mean for informed, patient holders. Today's briefing is dense with signal. Let's go layer by layer. Let me start with the hard truth that most people are completely missing. When the average retail investor looks at Ripple expanding into Australia, they see a press release. They see a headline. Maybe they bump the price target in their head a little and move on. But here is what is actually happening beneath the surface. And I want you to pay close attention to this because it explains everything about Ripple's strategy. Ripple did not apply for an Australian financial services license through the normal regulatory process. That process can take years. Hearings, submissions, waiting periods, back and forth with regulators. Instead, Ripple acquired BC Payments Australia Pty Limited, a subsidiary of Banking Circle Group, a European payments bank that services between 350 and 700 financial institutions and handles over 10% of European business-to-consumer commerce payments. Read that back. 10% of European B2C commerce payments flowing through a single institution. That is not a small fintech acquisition. That is Ripple purchasing a regulatory on-ramp and a proven institutional infrastructure simultaneously. What does this give Ripple? The AFSL license lets Ripple operate in Australia as a fully licensed end-to-end cross-border payment platform. Onboarding, compliance, foreign exchange, liquidity, payouts, all in one stack, all regulated, all live, not in a pilot, not in a sandbox, live. And this plugs directly into Ripple's Asia-Pacific payment engine, where payment volume nearly doubled in 2025. The wider XRP-powered network processed over $600 billion in payment volume last year. $600 billion. Now, here is the thing retail is not connecting. Australia is not the endgame. Australia is a node. It is one more junction point in a global regulatory lattice that Ripple has been quietly assembling, jurisdiction by jurisdiction, license by license, acquisition by acquisition, hidden road, standard custody, BC payments. These are not isolated deals. They are a deliberate, sequential construction of the most compliant, most regulated, most institutionally accessible cross-border payment network in the world. The infrastructure is not coming. It is already built. Let's do the math that the retail crowd consistently ignores. Australia's total payment market sits at approximately $2.29 trillion in annual flow. That is the addressable market Ripple just unlocked access to. Not tomorrow, not pending approval, but now, under a fully licensed operational structure. But zoom out further. Ripple's network is designed to move value across the rails that currently cost the global financial system an estimated $27 trillion in locked nostro-vostro capital. Banks around the world are required to pre-fund accounts in every jurisdiction where they operate. That capital sits idle. It earns nothing. It is the single most inefficient mechanism in the global financial system. and the XRP ledger exists specifically to eliminate it. Here is the liquidity math that should stop you in your tracks. To move $1 million across borders today using traditional correspondent banking, you need pre-positioned capital in both jurisdictions, plus a 2 to 5 business day settlement window, plus fees layered at every correspondent in the chain. Using XRP as a bridge asset, that same $1 million settles in 3 to 5 seconds. The XRP used is acquired, used, and liquidated in the same transaction. You do not need pre-positioned capital, you need sufficient liquidity at the current price. Now here is why price mathematically matters to Ripple's own infrastructure. At a lower XRP price, moving large sums requires a larger percentage of the available circulating supply, which creates slippage. As price rises, the same dollar volume of payment requires a smaller and smaller slice of total supply. Higher price equals higher efficiency. This is not a Moonboy talking point. This is how bridge asset liquidity mechanics literally work. Total fixed supply, 100 billion XRP. Circulating, approximately 57 billion. Of that, a significant portion is moving toward institutional custody and not returning to the open market. Exchange reserves are at multi-year lows, and with over $600 billion in annual payment volume already running through the network and growing, the demand side of this equation is accelerating while the available supply is contracting. This is not a prediction. It is the logical, mathematical outcome of supply-demand mechanics applied to a fixed cap asset with growing real-world utility. Now let's look at what the smart money is actually doing, because it contrasts sharply with how retail is behaving right now. First, Ripple just announced a $750 million share buyback. Let that land for a second. A company that 3 years ago was in the middle of an existential SEC lawsuit is now buying back $750 million of its own equity. You know who writes those checks? Institutional capital, fortress money, Citadel-tier players who do not write checks that size based on hope. They write checks that size based on legal certainty and revenue projection. The SEC tried to bury Ripple. The court rejected it. Now the same class of institutional money that was waiting on the sideline for legal clarity is writing the checks. That is not coincidence. That is sequencing. Second, MasterCard. MasterCard is expanding its blockchain partner program with over 85 companies, and Ripple is in that cohort. Ripple stated directly, digital assets are moving from experimentation to real use. Collaboration across the ecosystem is key to connecting on-chain innovation with trusted global infrastructure. Let me translate that for you. Ripple is not positioned as a disruptor trying to blow up the existing financial system. They are positioning as the interoperability layer inside the existing financial system. MasterCard has 3.7 billion cardholders and relationships with every major bank on the planet. When MasterCard expands into blockchain and Ripple is at the table, that is not a press release. That is a distribution channel for XRP-powered payment rails that dwarfs anything retail investors are modeling. Third, look at the broader institutional landscape. Wells Fargo just filed a USPTO trademark for a tokenized dollar deposit coin, a permissioned digital dollar for intrabank settlement, explicitly covering blockchain-based settlement services. Fidelity launched a stablecoin. Western Union launched a stablecoin. Franklin Templeton is calling tokenization a freight train that cannot be stopped. Robinhood's CEO said tokenization will eat the entire financial system. These are not fringe voices. These are the architects of the traditional financial system saying out loud that the rails are being rebuilt. And Ripple, with its 10-plus-year head start on regulatory licensing, its global payment network, and XRP as the native bridge asset, is positioned to be the interoperability layer between all of it. While retail is watching ETF flows go negative in March and getting nervous, institutions are signing agreements, acquiring licenses, and building cold storage positions. Ask yourself this: Does a company like Ripple authorize a $750 million buyback because they think the price is going down? Does MasterCard bring 85 blockchain companies into a formal partner program because they think this is a fad? Absolutely not. They position, quietly, deliberately, and well before the public catches up. So what is the ignition sequence from here? The Australian AFSL license is live. That means Ripple Payments is operational in the Asia-Pacific's most regulated financial market right now. The MasterCard Crypto Partner Program formalization is accelerating throughout 2026. As stablecoin legislation moves through Congress, and the signals from Washington are clearer than they have been in years, the regulatory risk premium on XRP will continue to compress. When that risk premium fully collapses, the wait-and-see institutional capital does not slowly trickle in. It gaps in. The tokenization wave is not a 10-year story anymore. Franklin Templeton, BlackRock, Fidelity, Robinhood, they are all saying 2026 is the year of activation. Non-speculative assets, treasuries, repo markets, real estate are expected to eclipse speculative token value on-chain within 2 years. When that happens, you need a bridge asset that can settle between these tokenized instruments in real time with regulatory compliance baked in. That description fits exactly one asset at scale. When the regulatory switch is fully flipped, the window for acquiring XRP at this price point does not slowly close. It closes fast. Here is what I need you to understand about where we are in the supply picture. We are moving from an era of abundant cheap XRP availability on exchanges to something structurally different. Exchange reserves are at multi-year lows. Institutional custody is absorbing supply that does not return to the market at 10% profit targets. It returns at price levels that reflect global settlement demand. Once a token enters a multi-signature institutional vault as part of a treasury reserve or an ODL liquidity position, it is functionally removed from retail circulation. Not temporarily. The math. 100 billion total, about 57 billion circulating, a growing portion in institutional hands, and a network that processed $600 billion in volume last year at current price levels. What happens to that math at 5x payment volume? At 10x? The required price to maintain liquidity efficiency is not something anyone gets to vote on. It's a function of the mechanics. Middle Eastern capital is quietly moving into digital assets right now, not into speculative plays, but into infrastructure-grade assets and stablecoins, specifically because of geopolitical uncertainty around traditional reserve currencies. That is new demand from a category of wealth that was not in this market 24 months ago. The door is not closed, but the hinge is moving. I know what some of you are feeling right now. March ETF flows are negative. The macro environment is choppy. Tom Lee is flagging a potential deeper market correction later in the year. The charts are not reading the way you want them to read. I want to validate that. It is not easy to hold through this kind of market. The noise is real. But here is the thing I want you to hold on to when the noise gets loud. The red candles do not change the regulatory foothold in Australia. The choppy ETF flows do not cancel the MasterCard partnership. The macro turbulence does not reverse the $600 billion in payment volume running through the XRP network. The signals that matter, the structural, institutional, regulatory signals, have never been stronger than they are right now. Being early feels exactly like being wrong. Right up until the moment it doesn't. The question is not whether the infrastructure Ripple is building will be used. We are past that question. The question is whether you are still holding a position in the network that settles it, or whether the noise shook you out before the structure became undeniable. The crowd reacts to price. The informed track behavior. And behavior, acquisitions, buybacks, partnerships, regulatory licenses, institutional filings, has been pointing in one direction for months. Let me close with this. Ripple bought a license. MasterCard opened the door. Fidelity, Franklin Templeton, Wells Fargo, Robinhood, they are all building on the same rails. The tokenization wave is not theoretical anymore. It is being constructed right now, in real time, piece by piece, in front of anyone willing to look past the price chart. Price is a distraction. Infrastructure is the reality. If you made it to the end of this video, drop rails in the comments. I want to know who actually understands what is being built here. And if you find this kind of structural analysis valuable, not the hype, the structure, subscribe. We show up every day to decode the signal. Stay patient, stay rational. The math doesn't lie, and the infrastructure is already in place. We will see you in the next one.